Most traders lose money not because their strategy is not good enough, but because they're using the wrong strategy in the wrong market condition. There are four states of market behavior: an uptrend, a downtrend, a sideways or ranging market, and finally, a choppy one. Each of these market states has its own unique characteristics and trading strategies, and understanding them is very important. In this video, I'm going to explain the market flow, price action, market structure, and trading setups related to each of the market conditions. So if that's something you're interested in, as always, please hit the like button to support our channel and subscribe if you're new. Let's start with a trending market. A trending market is when the price continuously moves in one direction. In an uptrend, the market makes higher highs and higher lows while respecting previous swing lows. Respecting the previous swing low means the price continuously breaks to the upside without dropping below the previous swing low. After the breakout, the lowest point of the pullback becomes our new swing low. Now our directional bias is bullish, and we will only look for buying opportunities as long as the price stays above this level. But what happens if the price breaks and closes below the swing low? This shows that buyers are losing control, and we are no longer in an uptrend. Similarly, in a downtrend, it's the opposite. The market makes lower lows and lower highs while respecting swing highs. We consider this a downtrend and look for selling opportunities as long as price stays below the previous swing high. Break of structure and change of character. Every time price breaks above the previous high in an uptrend with a strong close, we mark it as a break of structure, BOS, which signals trend continuation. This shows that buyers are still in control, so we look for buying opportunities. We then mark the start of the breakout move as our new swing low. Then we have our trading range like this. We expect the price to make a pullback, get rejected somewhere inside this range, and push higher, at least to the previous high. But what if price fails to push higher and instead closes below the swing low? This is called a change of character, chalk. It signals a possible reversal and shows that buyers are losing control of the market. After this, we can expect a potential shift in direction and start looking for selling opportunities. Another important reversal signal is a shift in momentum. In this example, we have a strong breakout with large candles. This shows strong bullish momentum and buying pressure. But suddenly, price drops and prints large bearish candles, signaling the opposite. This sudden shift in momentum shows that buyers are losing control and sellers are stepping in, which can lead to a potential reversal. A trending market is the cleanest and most profitable environment for traders. But not all trends are equal. Ideal and imperfect trends. An ideal trend is smooth, clean, and respects the structure clearly. Pullbacks are controlled, and the price reacts nicely at key levels. An imperfect trend, on the other hand, is messy. You may see deeper pullbacks, fake changes of character, and choppy structure. To avoid confusion in imperfect trends, you need to understand the market traps. Invalid change of characters. Number 1. Failure to continue. If price breaks below the swing low but fails to continue lower and quickly moves back up, the change of character becomes weak or invalid. Especially if the price then breaks back above the previous high, it confirms that the market is still bullish. Number 2. Liquidity hunt. If the swing low is placed in a liquidity area, price may briefly break below it to grab liquidity and then reverse. This was just a false move to grab liquidity, not a real reversal, which makes the change of character invalid. Number 3. Fair value gap mitigation. If there is a fair value gap below the swing low, price may drop to fill or mitigate it and then continue higher. In this case, the move down is only a reaction, not a real shift in structure, which invalidates the change of character. Now it's time to look at some of the best trading strategies for a trending market. We can divide them into two categories: trend continuation and reversal setups. The first one is buying the pullback. After a break of structure, we don't chase the price. Instead, we wait for a pullback to enter at a better price. We mark our range from the swing low to the new high, and then wait for the price to retrace into that area. The best idea is to look for a rejection inside the 618 Fibonacci level or from a fair value gap. Then we enter the trade, targeting at least the previous high. This is one of the safest and most consistent ways to trade in a trend. The next strategy is break and retest. In a bullish trend, wait for the price to form a double top rejection pattern. When price breaks above this key level, wait for it to come back and retest the area. If the level holds and price shows rejection, like a long wick candlestick, we enter the trade and place our stop loss below the zone. Similarly, in a bearish trend, wait for the price to form a double bottom rejection pattern. If price breaks below this key level, wait for it to come back and retest the area. If the level holds and price shows rejection, like an engulfing candlestick, enter the trade and place your stop loss above the zone. Now let's talk about reversal strategies. Number 3. Change of character entry. After a long-term bullish trend, wait for the price to make a change of character. To confirm the reversal, we need at least one or two strong bearish moves breaking below the swing low. Then, look for fair value gaps that form after the chalk. Set a sell limit at the start of the gap, place your stop loss above it, and target the next important level below the price. Number 4. Inversion fair value gap and liquidity grab. A high probability trading opportunity forms when price sweeps liquidity above the highs and then forms an inversion fair value gap. This shows a clear shift in momentum after a long uptrend. The market has taken buy-side liquidity, and now we anticipate a move towards sell-side liquidity. Combining the liquidity grab with an inversion fair value gap is a very powerful setup. Next, we have ranging markets. We always recommend focusing on trending markets, but the problem is that markets spend more time moving sideways than trending. If you focus solely on trends, you will miss many opportunities. That's why learning how to trade a range-bound market is very important if you want to be consistent. A sideways or ranging market is when the price stops making higher highs and higher lows, or lower highs and lower lows. Instead, price moves between a clear high and a clear low. This means the market is no longer trending and is moving sideways between support and resistance. In these conditions, we cannot use the same strategies as in a trending market, so we need to adjust our approach and trade the range differently. But first, how do we identify a ranging market? A simple way is to look for at least 2 rejections from the bottom and 2 rejections from the top. This shows that the price is respecting both support and resistance. Once we have these levels clearly respected, we can consider the market to be moving sideways. Keep in mind that more touches make the levels stronger, but they do not guarantee that the range will hold. Also, the cleaner the levels are, the better. When support and resistance are easy to identify and price reacts clearly from those areas, the range becomes more reliable and easier to trade. Now we reach the ranging market trading strategy. Number 1. The third touch. The third touch of a level is often the most important because it shows a high probability reaction. When price approaches a level for the third time, we look for confirmation that the level will hold. If we are at support, we look for rejection to the upside. We do not enter immediately on the touch. Instead, we wait for confirmation, such as a rejection wick or a strong move away from the level. Once we see that reaction, we can enter the trade. Keep in mind that you can also trade the next rejections, but with reduced risk. Number 2. Break and retest. When price breaks above resistance, it turns into support. We wait for price to come back and retest that level. If the level holds and price shows rejection, we look for buying opportunities. Similarly, in the bearish scenario, when price breaks below support, it turns into resistance. We wait for price to come back and retest that level. If the level holds and price shows rejection, we look for selling opportunities. Sometimes price breaks above resistance but fails to continue higher. This is called a failed breakout. Instead of holding above the level, price quickly moves back down and re-enters the range. This shows that the breakout was weak and buyers were unable to maintain control. This will cause breakout traders to fail their trades and suffer losses. To correct this issue, the next trading setup comes into play. The inside bar. The inside bar is a candlestick pattern where one candle is completely inside the range of the previous candle, called the mother candle. This shows a period of consolidation and indecision in the market. In an uptrend, it means buyers are pausing and not pushing price higher. In a downtrend, it shows sellers are losing momentum and the market is slowing down. This pause often happens before the next move. We trade inside bars as a continuation setup. First, we identify a strong trend. Then wait for the inside bar to form. After the pattern forms, we enter on the breakout of the inside bar. In an uptrend, we look for a buy after the breakout to the upside. In a downtrend, we look for a sell after the breakout to the downside, and our target is the next key level in the market. The best inside bar setups often happen in a ranging market. To avoid false breakouts, we wait for the price to first break above resistance, showing a potential breakout and continuation. After that, we wait for an inside bar to form. This confirms that the market is pausing before continuing. Once the price breaks above the inside bar pattern, we enter a buy position because this means that buyers have stepped in after the pause. Our stop loss is placed below the mother candle, and our target is the next key level. This way, we avoid false breakouts and only enter when the market confirms its direction. Next stop, we have choppy markets. A choppy market is a market where price moves in a messy and unpredictable way. Instead of following a clear trend or staying in a clean range, the price keeps moving up and down with no clear direction. It creates many false signals, making it difficult to trade. The best approach in a choppy market is to stay patient and avoid overtrading. It is often better to wait for the market to transition into a clear trend or a well-defined range before taking any trades. Choppy conditions are dangerous for traders because they can quickly lead to losses. The key is to recognize when the market is choppy and protect your capital by staying out. Now, here is an important point. Waiting for high-quality trades to develop and filtering out low-quality ones is a skill to develop. So guys, I hope this video has some value for you. If it did, make sure to like, comment, and subscribe for more content like this. See you in the next video.